Good morning, everyone. And by the way, thank you for attending this panel. Michael here was afraid that only 15 of his closest friends would show up, so appreciate it. Because the topic of today is pretty specific, but it's an important one. So good morning, my name is Sandra Rowe. I'm the CEO of the Global Blockchain Business Council. We have here to my left, Michael Morrow, CEO of Genesis Global Trading, very familiar face to the circuit, as well as Mike Belshie, CEO of BitGo. And to my far left, we've got Edward Woodford, who's the CEO of SeedCX. And let's kick off the conversation. So, on or off-chain settlement. Mike Belshie, can you start us off and give us some basics for the audience in case they're not so familiar about what is the debate about on versus off-chain settlement?
All right, sure. Well, overall, I'm not sure that there's actually a debate, but there's clearly some technical differences. Most trading today happens off-chain, right? And it's mostly done at centralized exchanges. But the benefits of the off-chain settlement are two things. A, we've got these fantastic blockchains which are incredibly transparent and incredibly authoritative about who makes transactions. So that's a benefit that you'd like to see. Well, you know that transactions have been settled fully on the blockchain, generally irreversible, a little bit depending on which blockchain you're on. But the trade-off is very clear. Unfortunately, when you go towards that, in the case of some of the more popular public networks today, they just don't scale to the levels that we like to trade at. For the last 100 years, traders have learned to trade faster and faster and faster and faster to the point of, trading bots that take care of it. So that's kind of the dilemma of settlement. It's actually a dilemma of trading in general. How do you trade fast when moving the assets is slow?
Yep. So as the industry scales, we're going to have a really interesting debate about, do we replicate the way traditional finance and settlement has occurred, or do we actually look at new models? And to explore that a bit further, Edward, I think you had a very interesting blog post in January, and I'm just going to read from a few lines here. So you say here that tokenization through Bitcoin and Ether is the wedge for broader asset tokenization. The potential value, if properly executed, could be immense. To put it in perspective, if just 1% of all tradable assets were tokenized, $3.2 trillion would come on chain. Credit Suisse estimated that there was $320 trillion of tradable assets, just to give you that figure. So tell us a little bit about what you guys are doing and how you're approaching settlement on chain and the sort of worldview of blockchain that you've got.
Yeah, thank you. So our view is that there's no need to have this binary distinction of on-chain and off-chain. We think that there are benefits of both, and there's obviously downsides of both, and Mike articulated those. Our view is that it makes sense for what we call a hybrid model. And so the way that we do that is essentially that the way that our settlement infrastructure works, both for our own exchanges, but also for third-party clients for whom we do settlement for. So that includes, for example, OTC providers, RFQ platforms, and other groups offshore, is that the way that settlement works on our infrastructure is that trading occurs off-chain, and then we basically net out those positions. So if you buy 10 and then sell 9, the net position is 1. And at the end of the trading session, there is an on-chain transaction of 1. And so what that allows you to do is that each participant on our own exchange and for our third parties actually has their own dedicated wallet. So there are the benefits, as Mike articulated, of being able to see your ownership without needing to trust a third party like ourselves. But you get the efficiency of high-speed transactions. And the way that our settlement infrastructure works is that you can customize it. Basically, you can do instantaneous settlements, so that means every single transaction goes on-chain. You can do batch, whereby there's a time horizon, whereby you can say, within these 2 hours, I would like to net these transactions off-chain and then ledger them on-chain. And then finally, there's the notional amount. So a lot of OTC traders, they're taking counterparty risk, and basically they want a settlement once they have a net exposure. And so it's kind of this hybrid model. And so we don't think you need these binary distinctions, and you're getting the benefits of both worlds.
Great. Mike Belshie, Could we talk a little bit about the approach that you guys have taken, because it's a different approach. So could you articulate a bit more about your custody and settlement solution?
Yeah. So BitGo's been focused on increasing trust in digital currencies. It's a hard thing to do. We got regulatory issues, we got technical issues, we got infrastructure issues, and in regards to settlement, it's kind of an infrastructure type of problem. Today, when you look at where settlement typically happens, it's on exchanges. These exchanges that grew the ecosystem early, they didn't have custodians to rely on. They didn't have independent broker-dealers, for the most part, to rely on. The parties that you would traditionally see around the table supporting the exchange didn't exist. So they ended up creating centralized exchanges. In order to build trust for institutional investors at the next level, writing a $250 million check to your favorite exchange, that's a tremendous amount of counterparty risk. And even if you're talking about the OTC markets, writing a check and just saying, hey, I hope that the Bitcoin shows up tomorrow is a pretty difficult thing to do. So if we want to get serious about having institutional investors be able to come into this market, we've got to have an infrastructure that supports them. That means having independent folks that are handling settlement. So BitGo's a qualified custodian. We're not traders. We're not an exchange. We're not going to be. We're not a custodian bolted onto an exchange. And that's quite deliberate, so that institutional investors know that we are just an independent party. We can help settle those trades without having to be a party to it.
Great. Thanks for that. So you've got a flavor here for a couple different approaches. I'm going to switch gears a little bit, because here's the reality. Having come from market infrastructure and trading myself, nobody cares unless settlement goes wrong or shit hits the fan. Am I allowed to curse? Oh, well, I already did. So let's think about it from a risk perspective, because let's face it, as soon as the numbers start getting really big and we start trading a lot and we start settling a lot and custodying a lot, when the numbers get really chunky, that's when institutions will care, and that's when also they'll be really do care around how we're approaching this. So I want to ask Michael Morrow here, from a client perspective, just what you're seeing right now. Are clients asking you a lot about this topic? Or are they worried about it? Are they looking at it? Do you get any inquiries? What do you think?
I probably get fewer questions on this than I should. And I think that's kind of the reality of the space. I think Sandra's 100% correct. I think that back office, middle office type stuff, sort of the unsexy portion of this, is where, at least sort of in the OTC world, a lot of the settlement, the risk is in the actual transaction. It's not so much the buying and selling and agreeing on a price. That's probably the easy part that people tend to kind of focus on. A lot of the points that sort of both Mike and Edward kind of touched on, and Edward's point about, hey, I bought 10 and I sold 9, so let's net the 1 Bitcoin, and also kind of netting out the dollar proceeds portion of it, right? It makes it really easy on the ops guys that only have send 1 Bitcoin. But it ultimately is the question is the accounting guys have to say, okay, but which 2 trades did you net out? Yep. So it's a record-keeping question. And a lot of the systems are like, okay, you don't want to be picking and choosing which trade you settled to kind of net settle at that point perspective. And I think that, so there's accounting, netting makes it easier for some people, but really confusing for the accounting and audit department unless they have their records completely straight, which can be sometimes hard to kind of come by. On the other hand, we also have counterparties that are like, look, I don't want to hold anything, okay? And this whole hacking, maintaining private keys part scares me, but I want to see my coins. I want to be able to pop in an address on the blockchain and see my coins that are there, right? So there's a commingling aspect of potential off-chain transactions that tend to be like, okay, I understand that there's 10,000 Bitcoins in this address and 1,000 of it's mine, but 9,000 isn't, versus, hey, I need a specific address with just 1,000 Bitcoins in it, which I know is mine, even though I don't have the private keys. So it's an auditing and accounting question as it relates to settlements, much more than the actual trading risk.
Yes, and when actually, it's a good point you raised, and we're going to delve into this a little bit more, because this is actually a really important part, again, when things go wrong. When things are going swimmingly, people are like high-fiving, all right, making money, great. But when things go wrong, the record keeping, the ability to prove something is here or the number is correct, when you have the disputes is actually where a lot of the challenges are today. And we hear about reconciliation, we hear about omnibus accounts versus segregated individual accounts. Operationally, these things are very tough as you get bigger and bigger and bigger and more complex. So when we think about it from a client perspective, as we are in many ways have the opportunity to reinvent the way, or sorry, reconfigure the way we do these processes, what are some of the big gaps do you think we need to still cover in order for us to have a better, efficient settlement and custody offering to really get into the big leagues, right?
Sure, I'll take that. The net settlement system that we're using, or maybe we're addicted to today, comes from this idea that we like to trade fast, but it's hard to actually move the asset. And so how did the traders continue to move faster on the trading without settling? Well, they had to decouple these systems. And net settlement ultimately becomes kind of a requirement because you've got so many trades, it's just too much to keep track of. And so it's just easier. But why do we have to have that? Actually, the great thing about digital is we can finally fix this problem. We can try to match the metaphors that we used in other asset classes, but we have the ability to create digital money, we have the ability to create digital asset, and we have the ability to atomically swap them. So I think we need to be moving towards that model. Today, when you think about what happens, the folks that are participating in a net settlement are all participating in counterparty risk with each other. And so now you have to have a clearinghouse that steps in and says, I'm going to stand up in case anybody can't meet their obligation, and then everybody pays fees for that. What is that really, right? I mean, really, it's a loan, right? The guys that traded didn't have the asset until they had to settle a day later, so they borrowed the asset. Who'd they borrow it from? The other participants of the net settlement. That's risk, that creates cost. It's unnecessary. So it's going to take time to get there because the technology isn't quite ready for perfect atomic swap on-chain at the volume that we need, but that's where it's going. I think we should keep our eye on changing and cleaning up clearing and settlement.
I think maybe on that point, look, obviously there's problems around scalability in the networks. But our view is that we are bullish on the asset class as a whole, so we should use some benefits of the blockchain. If we're not bullish and we don't, as a group, use the benefits of the blockchain, then how can we be involved in this space is basically our view. So we're very bullish on kind of trying to decentralize in some facets of that. And I think it goes beyond just the settlement piece. I think sometimes this element of trust is just looked at from a crypto perspective, but trust actually matters, and it matters a lot more recently. So you've had examples like MF Global, a massive group that blew up. You had last year, one of the biggest clearinghouses in the world, they had a massive shortfall. This kind of concept of needing to have an immutable ledger without needing to trust a third party has resonance beyond just kind of this world of crypto. And I think that's the power of what we're trying to build, which is being able to expand this beyond just Bitcoin and ETH, but actually be able to have a decentralized system for other asset classes that can then be used.
Okay. So, Mike, do you have a view on that?
Yeah, I do. So here's kind of not necessarily the counter argument, but I think here's kind of the challenge with
let's have a
potentially
fight.
where
Come
we're
on.
going. No, I have no interest in picking a fight. We believe that sort of crypto is sort of an asset class on its own. It is a brand new vertical. It's not like stocks, it's not like bonds, it's not like gold, certainly. Crypto shares kind of characteristics across them, but it is a unique being. But the fact of the matter is, institutional firms are still going after the same pool of money that is currently investing in stocks and bonds and gold and FX and kind of everything else, right? The challenge, I think, is can we get them to start settling crypto in a way they don't settle anything else? It'll be a unique form of settlement that we're trying to apply with kind of the benefits of blockchain. And can we get the middle and back office of the biggest institutions and hedge funds in the world to start saying, yeah, we do everything like this over here, but crypto, we're good settling it this brand new way. I think there is certainly a hurdle to kind of getting some of those institutions. I think the benefit, though, potentially, is perhaps there is a larger story to be told about, hey, maybe we fix the way we're settling equities or fixed income or currencies and take the crypto model that Mike was kind of talking about to the next level to potentially disrupt other areas. But it's a larger conversation probably for another day.
Maybe just to mention a point on that. I think that the value of what we're trying to build by maintaining assets on chain. So you spoke about hurdles. If you hold assets in cold storage, it takes considerable time for you to get them out. So if you have one big cold wallet and you build a ledger on top, that makes a lot of sense if everybody's in that omnibus wallet. But the hurdle there is that, look, there's a lot of big players who just simply will not enter that space. And there's a network effect in all of these things. And so to convince people to come into one omnibus wallet, I think is a bigger hurdle than what we're trying to do, which is basically integrate ourselves. And by holding assets on chain, they can be moved as quickly as you like. And so there's the benefit of our settlements whereby you have this system which can then interact with the entire blockchain ecosystem in kind of real time.
Mm-hmm.
So let's talk about financial stability, because that is the #1 term that comes up after market manipulation mitigation efforts when you talk to regulators. Financial stability is a core tenet of what regulators are meant to do. So when we think about making changes to the settlement and custody cycle, or part of the life cycle of the trade, how do we give comfort to regulators that these approaches that we're taking are, let's face it, not proven in markets yet, the new ones, I mean? Because at the end of the day, some people will argue to you that during the financial crisis, clearing houses actually stood up and actually did cover and did provide stability and were able to port books when a trading counterparty went down, and actually risk mitigation was very sound. It was messy, don't get me wrong, but they will make that argument that during the financial crisis meltdown, clearinghouses actually did quite well. So how do you, and I think I'm pointing this really to Edward, how do we get across and articulate the soundness of new approaches, especially decentralized ones?
Yeah, I mean, I think that goes to my point about that neither approach is absolutely 100% correct. If you are centralizing risk, centralization makes a huge amount of sense for insurance, right? I mean, that's how insurance works, is that you're distributing risk. So the more risk you put into the pool, the more you're distributing it, and you actually get a better management of that risk. But there is still risk in that system, and there's a lot of talk about clearing in the crypto landscape. I mean, a lot of this is still being done over OTC. And when you look at conventional asset classes, there's a huge amount which isn't centrally cleared. Now, that's not to say that central clearing doesn't have a massive place to play. It clearly does. But that there is those counterparty risks that still exist. You're still taking counterparty risk to some degree. It's obviously massively mitigated through a clearinghouse. But there's things that you can do, right? I mean, the power of the blockchain is also that you have proof of the assets held. And so when we talk about risk, one of the risks that you're taking is counterparty risk. So if you hold assets on chain, the beauty of having a decentralized system in that sense is that you can actually prove ownership. You don't need a third party. And so you can actually start to reduce counterparty risk. You can start to stream back from the blockchain, this is what this ownership actually is. And I think it can, in some functions, reduce counterparty risk. But it's not to say that we want a completely decentralized system or completely centralized system. There are benefits to both for certain asset classes, but we think somewhere in the middle makes some sense.
Yep. I'm going to go back to your points, all three of you actually. During the financial crisis, one of the biggest issues was the information sharing. Positions, where was what, in what accounts, a mess. So I will say, what blockchain can do is cleaning up a lot of the efficiency around secure, truthful record keeping that in another financial situation or crisis, we will have better information to be able to mitigate the risk better and faster. So I completely agree with you there. By the way, guys, we want this to be interactive for those who want to engage in the debate. So if you are interested in asking any questions, please go up to the mics that are right here on either side, and let's talk in the last 10 minutes that we've got here. But I'm going to move on to last year. When you look at the last year or the year before and where we are today, I want you to give me a positive and a potential risk or challenge that you still see in the market. So I'm going to address that to each of you. So what do you see that's a positive that's happened in the market in the last year or two, and then a negative or a challenge?
Sure, I'll go first. The fact that in the last year, we saw sort of a 90% pullback in crypto prices, and the fact that we're all still here is a huge positive, right? I'm not sure I could point to any other asset class where this happens and we all still have jobs. We can all still pay to attend these conferences, right? You know, I'm kind of laughing about it, but I think the resiliency of the asset class and the participants in it certainly, I think, is a huge positive. The challenges, look, I think that when you compare crypto to some of the other asset classes that have like decades of history, or you're like, Bitcoin isn't gold. Gold has thousands of years of a history kind of track record, right? I think that it's probably easy enough to kind of poke holes in the asset class, frankly, if you look hard enough. And you may not even have to look all that hard to find some of the deficiencies, right? But I think it's important to like appreciate just how far we've come along in just a short period of time. When Genesis first started in 2013, you know, the fact that, you know, the CME Bitcoin futures contract would be actually a thing was a far-fetched dream. And while, like I said, I think a lot of the topics we're talking about, sort of settlements and potential custody and kind of areas like that, certainly third-party insurance is certainly something that's kind of lacking and a need for in this industry. No, I feel, like I said, I feel much, much better in 2019 than certainly a year ago.
I love the optimism. This is awesome.
Well, let's see. I would say, and this is a little bit, you know, around the custody angle. There's a whole number of different approaches being taken for how to kind of work the market structure. You got ErisX with their model, kind of coming under the CFTC model. You've got Fidelity, what they're doing through their asset manager to make crypto available. You got Bakkt coming online. Looks like we got good movement there. Having all these different models coming together at the same time, we're going to figure out which one works best. I think it's really encouraging that we're seeing competition between these different parties for how to best address digital assets. On the challenge space, you know, we're still failing on some fundamentals. We had a hack every month of an exchange last year, and it looks like we're on track this year to do it again. So I hope that they get less, but they have to get to zero. Like, if you really want to build trust and confidence in what we're doing, we have to make that issue go away. So that's I think, still our challenge. We have not yet figured out how to secure these assets adequately.
Maybe tied to that point, one of the challenges that we see is, it's kind of one of the paradoxes of cryptocurrencies, maybe tied to this to this topic, which is decentralized, you know, how centralized versus decentralized. I think there's a lot of systematic risk in the system that people aren't thinking about. If you look at what happened when, for example, Binance stopped withdrawals, that has a lot of trickle-down effects. That has huge effects. That starts to implicate people who then don't start to meet margin calls. It's not that they're not good for the position, it's just that they simply cannot get assets off one of the biggest exchanges in the world. And that has real trickle-down effects into the whole industry. Yep. I think when we look at some of the positives, it's again, this concept, tying it back to centralization, decentralization, this kind of ecosystem sense. I think we're starting to see, for example, other actors that are needed really enter the space. So for example, we can now offer 20 different types of fiat currencies. I think maybe 3-4 years ago, to offer that many fiat currencies would have been unheard of. And I think you're starting to see, similar to Mike's point, about regulators. I think you're starting to get a greater awareness, a greater understanding, and I think you know, this year we will also be able to launch a physically settled forward contract on our swap execution facility. So those are kind of positives and negatives.
Great. I will add one point to what Edward just said with regards to the power and the ability to move markets of one institution that actually does wield that much power. It is a real issue because, let's face it, right now, we don't even have leverage and real margining in the system, let alone exotic or derivative products of any major notional. So once we start having multitudes of different types of products, as well as massive leverage in the system, we are going to see some potentially big issues around liquidity and risk management if we don't have a better way of not relying on one big entity. Do you guys have a view on that?
Completely agree. I think that you know, things like margin trading is still an untapped source of potential volume. And there's this part of me that's like, crypto is volatile enough. Why do you need to add leverage to it to make it even more sort of a choppy returns kind of conversation? But I think that over time, I think we'll still expect kind of volatility to temper. But the systems, the infrastructure, all of that just not ready for like real massive scale margin trading today. Certainly in the sort of the true kind of spot market. And so in a way, it's probably good that it doesn't exist because I'm not sure that this world is, we're sort of at that point yet.
But we're getting there, So I'll take a question from the floor to my left, the first mic to my left.
Okay, this would be a question for Mike there. My name's Gerard Brennan. I'm a researcher at Rutgers on auditing and accounting technology, and I work also with Luca, formerly Libra, that does middle and back office accounting. And this off-chain issue, what we've tried to do is build a system of record across the whole ecosystem so that it's not just the blockchain that we're, and I think that if institutional money is going to come in, they're going to have to, we've also worked with the PCOB and AICPA and other regulators, they're going to have accounting and reporting on end-to-end transactions. And I guess I'm just wondering, what do you think is the right approach? And then later we're going to have to audit the blockchain itself, and that's going to require an ecosystem-wide approach. So I was just wondering, Mike, in expanding on your idea of middle and back office, do you think we're getting there? You have a database. We're using a SOC certification to accredit the database, but do you think we're getting there, that it will invite the institutional money, that they have no choice? They can't not just ignore, they can't ignore financial reporting requirements in accounting.
Look, blockchains, whether they're on-chain transactions or off, they're just tools, right? I mean, at the end of the day, these are just record systems that we use, and they've got some pros and some cons. But for auditing financials for companies, you're going to have to do far more than that. You've got asset classes that you've got to mix and match from here and there and line up all kinds of things. So there's not going to be like a silver bullet that solves the whole problem just through one stop. The blockchains do give us a level of transparency we've never seen before that can be audited in a public way when it's a public blockchain. If it's a private or permission thing, then you lose that benefit. When you look at Tether and the challenges that they've had with auditing or proving that they've got the fiat, you can see what the problem is. Are there accountants that can go figure it out? Yes. Can we trust them? We don't know, right? If it were on chain and you're like, there's the Bitcoin, there's no question about it. Everybody can verify it mathematically. So, I mean, I'm not sure if that answers your question. There's a lot of work that goes into financial audits, as you know, and I think it's much bigger than just a blockchain question. Are we making inroads? Yeah, okay.
Great. Question to the right here, the first mic.
Just from your vantage point, one of the original promises of blockchain technology had to do with back office being, for Wall Street, being really reduced, if not eliminated. From the conversation hearing today, obviously we have a problem now or a sort of situation of on-chain, off-chain. Do you see that vision of still eliminating back office procedures, or are we going to still have the same level of weight that we have today in Wall Street?
Can you introduce yourself?
Oh, I'm Jason Brett, Executive Director from the Value Technology Foundation.
So I think, I don't know if it's there to eliminate, maybe to enhance. I think the problem is this kind of critical mass question that I raised before. All of these systems need to talk to each other, and it's about getting everybody on the same system. And the problem with downstream reporting is that they're super archaic systems, 30, 40, 50 years old. And the problem is it's like a series of cogs across the whole entity. So once you change one, you change all the ones through the entire system. And then imagine that's in one entity. Imagine that over the entire ecosystem. So I think it's that kind of critical mass question. I think there are benefits. I think we are making inroads, as Mike mentioned, but it's not going to be an overnight thing by any stretch.
That the blockchains have been hyped as a panacea to many types of problems, and they're not. Blockchains are useful when you have multiple parties that do not trust each other writing to a common database, and that's where they're helpful. So if you've got a back office system between multiple banks that don't fully trust each other, it can help. It's really up to those banks to kind of figure out how to do that back office side in a way that they're satisfied with.
Great. Mike to the left.
John Garfield with Bond One. It's a very similar question. Very similar question as the one before, but when it deals with blockchain settlement, a lot of the advantages people talk about also has to do with there not being as much risk with administrative, physically putting in the transactions. But right now, you seem to mention that it's still a off-chain transaction, then you just net it and record it on-chain. Where do you see the timeline going for these back office things to be completely automated so you don't have these kind of risks that are apparent?
I couldn't quite hear the question.
Maybe I can repeat the question. So the timeline for potentially the entire system being decentralized rather than kind of our solution where it's half a hybrid model.
Existing institutions? Yeah. Yeah. Have you worked in back office of a big institution?
Not apparently.
I think there's a cost element, right? I mean, right now, transaction costs are pretty high. If you put all of the transactions that we do for our clients on chain, it would be a pretty expensive element. And for any institution to really make a change, it doesn't need to be 1x better, it doesn't need to be 2x better, it really needs to be 10, 20, 30x better. And as soon as the cost goes up, it really stops people from really being keen. So I think that's one of the reasons why we've kind of done this hybrid system. It's just that it would be very, very expensive, along with the scalability points as well. But it goes back to that point of COGS. You change one element, it changes everything else across a whole ecosystem. I think there's benefits, and there will be elements, and there's going to be things like zero-knowledge proofs that may make some inroads, but that's not going to be for every asset class. I think it's going to be for some asset classes in some jurisdictions.
Yeah, I'll add. On the trading side, I'd actually much rather automate the trading rather than the back office. In a way, like having automated processes to send out bank wires or bitcoins and potentially having private keys like in a system, I think that's kind of where the security vulnerabilities and kind of like hacks kind of tend to happen. So I think there's a lot of questions around security that we still kind of need to get comfortable with, and whatever systems that can develop to potentially mitigate some of that risk. But I still feel better that there is still a human being sort of sending out wires and kind of things like that just to make sure things go okay. Because the risk of what if it goes wrong is so huge in a potential back office settlement structure.
So I apologize, we're out of time. So your question we'll have to do bilaterally, but quick lightning round. What are you looking forward to in the next year? What is the most excited thing, or what is the thing that excites you the most about building out of this infrastructure? Start with Edward.
I think the growth of derivatives in both bilateral and a multilateral sense, and our settlement infrastructure can also actually manage bilateral variation margin. So that growth, particularly in Asia, has been seen over the last 6 months, and I think that will start to spread west.
Great.
I think the ecosystem is getting healthier in terms of being able to support an infrastructure as opposed to just small independent parties. So I'm seeing a willingness for partnerships between firms that take on different functions that used to want to try to consolidate it because they weren't healthy enough from a business perspective to pay or partnership. So anyway, I think we're getting a lot better towards the infrastructure.
I'll point to two things. I think one, I'll piggyback a little bit off of Edward. I'm really looking for sort of asset-settled derivatives rather than sort of cash settle, and potentially eliminate any kind of basis risk between I own a Bitcoin, but I'm selling a cash future. You're still not like perfectly hedged, and a physically settled Bitcoin future or derivative, I think, kind of provides kind of like perfect hedging scenario. And two, this is just purely as an individual DeFi. I am fascinated by the world of decentralized finance and what it could potentially do. But like, I kind of view it as like a science experiment to see whether or not it could potentially work and potentially scale. Whether that works for institutions, I think, is a separate conversation, but I think certainly at the retail, peer-to-peer, individual level, I'm sort of following that relatively closely to kind of see what happens.
Great, guys. Well, thank you very much for everyone who's attended, and feel free to reach out to them.